During July, we had global equities rise 0.7%, really extending this broad rally that we've seen for a while now. So we have global equities up for 6 consecutive months, also up 13% year to date in 2021, and impressively off the lows that we saw in March 2020, global equities have now risen more than 90%. So it's a very impressive rally off of the extreme pessimism we had originally at the beginning of COVID. In terms of July, for investors globally, there was really three key things that they were focused on. The first one being Delta, so the resurgence of increased cases around the world. What this means for a reopening both domestically, will we see further lockdowns? But also, does this push out the expectation for a global synchronized reopening and borders unlocking around the world? When it comes to inflation is one where investors were really thinking about the duration and how hot this could be. And we saw inflation reported for June in July. This was reported at 4.5% for core inflation, which on a standalone basis is very impressive. It's the highest core inflation the US has seen since 1991. We also saw GDP growth. So for the second quarter of 2021, we had US GDP growth come through at 6.5%. And it was further growing from the first quarter this year. But what we actually saw was that investors did have even higher expectations than that. So this whole debate around will inflation be temporary or not, will we see GDP growth peak, at least in terms of what we're seeing with interest rates and the yield curve, globally investors are starting to question how hot and how long this cycle may go for. So we did see interest rates in the form of the US 10-year Treasury yield continue to compress or decline. So from the peak in March 2021, where we did see interest rates higher at 1.75%, they have now trended back further down towards 1.2%, really putting the question in the mind right now around how do you invest going forward for an economic cycle that may not be as long or as hot as originally anticipated. Perhaps the most noteworthy news for July was news that came out of China. We had the regulator there bring out a new policy that requires a lot of the education companies, specifically those listed companies providing online tutoring services, to transition to be non-profits. As a result, we saw a range of these companies fall as much as 80% in just a couple of trading days. And this is something that really extended to the broader China equity market. So broadly for China, we saw that market fall 14%, which is dramatically underperforming the rest of the global equities index and developed market peers like the US. And investors now are questioning how much reach does this regulator have and what are their intentions to regulate other sectors in the same fashion. Going forward from here, it's something that we're spending a lot of time on, really trying to absorb what the next moves may be. Is this more temporary policy? Is it something that emulates some of the policy we have already seen in this decade? And if so, it is very important to decipher who will be the winners and the losers, because getting this right could see extremes on either side. So as we look forward now, one thing that we're paying particular attention to is the current earnings season that we're having. So for the second quarter, we're having all of the companies in the US report their current business trends, but also earnings and profits. And we can really get a strong gauge of which businesses are continuing to grow post the huge tailwind they had during COVID. Is it just a one-time tailwind or not? But also we'll get good company insights into the various pressures that they're seeing. Is inflation starting to have an impact on their margins? Are they struggling to get employees with some of the stretched labour market? And this gives us a good insight into how the economy progresses from here, but also where we want to be positioned within portfolios.